Hello, my name is Benjamin Tan, and I'm the Securities and Education course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Hello again. Welcome back to the SEC Winter Special Crash Course. My name is Jay, and this time I'll be talking about commodities. If you hadn't heard my previous lecture on FX, by way of introduction, I'm currently in my final year doing my Masters in Physics at Imperial. Last summer I had the amazing opportunity to do an internship with the FX and Commodities desk over at BNP Paribas, where I'll be returning at the end of the academic year. So hopefully I can share some of my learnings with you today. In this episode, as I said, we're doing a deep dive into the world of commodities. From natural gas used to heat your shower in the morning, the rice you eat for lunch, to steel used to construct the very building which you are in. Commodities are the fundamental building blocks of our modern lives. Think of commodities like the ingredients in a cake. Just like how flour, sugar, and eggs are essential for baking, commodities like oil, gold, and wheat are the raw materials used to create the products and services we rely on every day. One key feature of commodities is their fungibility. But what does that word even mean? In simple terms, it means that a gold bar from South Africa is practically the same as a gold bar from Australia, as long as they have the same purity. It doesn't matter where the gold bar is from, because it's just gold. This interchangeability allows for a single global price for each commodity. So, to formally define the word commodities, we can say that they are basic goods possessing fungibility. To make things a little easier, we can group commodities into hard and soft categories. Hard commodities like oil and gold are extracted from the earth. These include energy resources like crude oil or natural gas, and metals such as gold, silver, copper, and aluminium. Soft commodities like coffee and wheat are grown and cultivated. This category includes agricultural products like corn, rice, livestock, and meat. If you're interested, you can pause right here and quickly search the price of all these commodities online. I'd highly recommend a website called tradingeconomics.com, a tool I used all the time during my internship, and a great substitute if you don't have access to a Bloomberg terminal. If you search far enough, you may come across a ticker for orange juice. And I'm not joking when I say this, you can literally invest in frozen concentrated orange juice futures contracts on the Intercontinental Exchange. As of today, a Jan 25 contract is selling roughly for 5 cents a pound. Crazy, I know. Just a heads up, I know I've mentioned some phrases like Jan 25 and futures contracts, but don't worry, I've got you covered later in the episode. Or if you've heard of these terms before from the previous episodes and you'd just like to remind yourself what they are, keep listening. Okay, now it's time to talk about who the key players are in the commodities market. Broadly speaking, there are two types of participants, hedgers and speculators. These groups play distinct roles and approach the market with entirely different goals. Hedgers are commercial participants who either produce or consume commodities as part of their core business operations. Their primary objective is to reduce price volatility and protect themselves from market uncertainty. I'm going to give you two examples of hedgers, with one on the buy side and one on the sell side, so we can understand how it works from both sides. On the buy side, I'd like you to think about an airline company. Its profitability heavily depends on fuel prices, which can fluctuate wildly. To shield itself from these price swings, the airline purchases fuel contracts in bulk, securing a stable cost and avoiding potential spikes. On the sell side, however, consider a farmer growing corn. The farmer might worry that corn prices will drop by the time they're ready to harvest. To secure their earnings, they can sell corn futures contracts at today's price, ensuring a guaranteed return no matter what happens in the market. The second most common participant in commodities are speculators. Speculators could be anyone from individual investors like yourself to seasoned traders at major firms. For example, you and I might be eyeing gold prices for an opportunity to profit, while a commodities trader on Wall Street works with the advanced algorithms to make split-second trades. So to sum up, hedgers aim to minimize risk, while speculators look to maximize profits. Both groups bring balance and liquidity to the market, keeping the commodities world in motion. Now, you might be wondering, why should you even consider trading commodities? After all, isn't investing in stocks or bonds the go-to move? Well, commodities have been historically overlooked by investors, but the commodities bull run of the 90s and the noughties changed the game, grabbing the attention of speculators and leading to the creation of numerous investment instruments like forwards and options. Firstly, commodities have strong long-term fundamentals. Fun fact, in 2022 we hit 8 billion people, and in 2055 that number is expected to balloon to 10 billion. What do all of these people need? Food to eat, homes to live in, fuel for transportation, and much more. As global populations grow and compete for all the world's finite resources, the laws of supply and demand suggest that commodity prices will rise in tandem with increasing demand. Urbanization and industrialization are driving massive demand for commodities. In the early 20th century, less than 15% of the global population lived in urban areas. Now, over half the world are living in cities, and it's set to reach 68% by 2050. This demonstrates the growing need for increased fuel consumption in the years to come. Meanwhile, fast-growing economies like the BRICS nations, Brazil, Russia, India, China, and South Africa, are competing for key resources like steel and oil to power their industrial expansion, further pushing commodity prices upward. Another reason to invest in commodities is to hedge against inflation. Inflation is a sneaky thief, quietly reducing the purchasing power of your assets. In times of high inflation, such as the 11.1% inflation rate in the UK in November 2022, traditional investments like stocks often underperform due to rising business costs. Commodities, on the other hand, tend to thrive during inflationary periods because rising commodity prices are often a primary contributor to inflation itself. In short, commodities can serve as a natural hedge against inflation. Lastly, I want to discuss how they can be a safe haven asset. When the financial markets get rocky, whether due to a pandemic or currency devaluation, some investors turn to precious metals like gold and silver. These are seen as so-called safe haven assets that can maintain or even increase in value during periods of uncertainty. For instance, during the COVID-19 pandemic and the war in Ukraine, gold proved to be a reliable store of value for many. There are a whole host of other reasons to invest in commodities, but these are the ones I personally find the most compelling and relevant to today's market dynamics. Great. We've covered a lot today, and it's clear that at its core, trading commodities revolves around the laws of supply and demand, much like the other asset classes we've discussed in this series. But here's the million-dollar question. How can you get started trading commodities? Before we dive in, let me just say this is not financial advice. If it were, I'd be charging a hefty consulting fee, or better yet, sipping pina coladas on a private island funded by my own genius trades. So take this as informational, not your next big investment strategy. Earlier in the episode, I mentioned investing in orange juice futures contracts. That's just one way to gain exposure to commodities. Futures are standardized agreements to buy or sell commodities at a specified price on a set future date. These are highly liquid and traded on exchanges like the Chicago Mercantile Exchange Group. A similar but more flexible option is the forwards contracts. Like futures, these contracts allow you to agree on a future price for a commodity, but they're traded over the counter, meaning they're customized to fit your specific needs. You can negotiate the terms directly with the counterparty, whether it's the quantity or delivery dates. If you're looking for even more flexibility in how you trade commodities, options contracts might be the right choice. An option gives you the right, but not the obligation to buy or sell a commodity at a predetermined price within a specified time frame. This means you can profit from price movements without being locked into a full commitment. All of these investment vehicles are discussed in further detail on the derivatives episode, so make sure to check that out, because it's also important to understand the risks involved in each one. For those seeking exposure to commodities without directly trading contracts, commodity ETFs and mutual funds provide simpler, more passive options by tracking a variety of commodities. Finally, for those looking for professional expertise, commodity trading advisors, also known as CTAs, manage investments in commodities on behalf of their clients. These managers are specialized in the commodities markets and use their expertise to make informed trading decisions. so they can be an excellent choice if you want to leave the trading to the professionals. Okay, let's take a breather. That's a lot of options to consider, but the more choices you have, the better equipped you'll be to find the right strategy that aligns with your goals and risk tolerance. In this section, I want to talk to you a bit more about a particular commodity, crude oil. Crude oil is vital to the global energy market, providing about 40% of the world's energy needs. The Middle East dominates oil reserves, with giants like Saudi Arabia, Iraq, and Iran holding the largest shares. Despite this, the US is currently leading production at 13 million barrels per day, followed by Russia and Saudi Arabia. This ranking is fluid, influenced by several factors and the strategies of OPEC, an organization that controls a significant portion of the world's oil supply. OPEC plays a crucial role in regulating production to stabilize prices. As the world pushes towards net zero carbon goals for 2030 and 2050, I think it will be interesting to see how OPEC adjusts its role for the global energy transition, balancing supply with the increasing demand for clean energy. So, we've discussed a little bit about crude oil. Now I want you to go on Google and pull up a graph of crude oil prices over the past decade. Have a look to see if you notice anything interesting. Looking at the graph of crude oil prices, we can see how key events have caused dramatic fluctuations. One of the most significant drops occurred in 2014, when the price of oil crashed from around $100 per barrel to $50. This was primarily due to a surge in US shale production combined with OPEC's decision not to cut production. Fast forward to 2020. The COVID-19 pandemic resulted in a historic crash, with prices dipping into even negative territory in April due to plummeting demand and an oil price war between Russia and Saudi Arabia. Then, as economies slowly began recovering, prices started climbing again. The Russia-Ukraine war in 2022 sparked another surge, as sanctions on Russian oil and disruptions to supply chains caused prices to skyrocket. Throughout this period, global geopolitical events, OPEC decisions, and shifting global demand have played a constant role in shaping price movements. So yeah, you can clearly see that a lot of commodities is driven by geopolitical events and organizational decisions. So if this is something that you're interested in, commodities might be interesting for you to look at as a career. And now, as we come to the end of this episode, let's take a quick look at some key market indicators that can track the health of the commodities market and identify potential trade opportunities. Firstly, we have the Consumer Price Index, or more commonly known as CPI, which tracks inflation and is often closely tied to commodity prices. Secondly, we have the EIA inventory reports, which provide insights into energy supply levels and GDP data. This signals economic growth. In the US, crude oil is referred to as West Texas Intermediate, or WTI. This is a major global benchmark, and the strength of the US dollar impacts most commodities since they're priced in the dollar. Additionally, the Purchasing Managers Index, or more commonly known as PMI, offers insight into manufacturing activity. A score above 50 means that the economy is expanding, whereas a score below 50 means the economy is contracting, and this can directly affect commodity markets. During my internship, we paid close attention to inventory reports and PMI data, especially for energy commodities like crude oil and natural gas. These indicators were essential for understanding market sentiment and predicting potential price movements. I definitely recommend having a look at these from time to time to see if it influences price changes in the relevant commodity. Okay, well done for making it to the end of the episode. It was a pretty hefty one. Commodities are fascinating and dynamic assets that serve as the back of the global economy. From their fungibility to their categorization into hard and soft types, understanding the basics is the first step into exploring this market. We've discussed key players, trading mechanisms, and investment vehicles, and even explored the critical role of crude oil. By incorporating commodities into your portfolio, you can hedge against inflation, diversify your investments, and tap into strong long-term fundamentals driven by urbanization, population growth, and industrialization. Thank you for tuning in to this episode of the SEC Winter Special Crash Course. I hope you now feel more equipped to navigate the world of commodities. Bye-bye for now.
Credit to our producers, Aaliyah Friedman, Louis Kim. Head of Marketing, Samhat Raman. Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi. Juniors, Aditya Mutha Kumar, Kwan Lin. Head Liaison, Lucrezia Poloni. Junior, Ekaterina Vitor. Head of Audio, Isaac Chu. Junior, Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh, Jet Lee.